In this recording, we're going to look at the big picture of inventory. Much of it will be a review of what you've had in a prior class, but it also may go into some things that your prior course didn't get into. So let's look at the basic income statement. In prior chapters, we actually started with net sales, but starting with chapter 8, we're actually going to look at, well, we can have sales that are gross, but how do we get down to net sales? Well, if we offer out discounts, so if we reduce our price on the goods, that creates a sales discount. And so usually we like to track that. Here's what we sold, here's our original selling price, and here's a discount, perhaps for paying early. And then if the customers return any of the goods, it's also helpful for management purposes to track the volume and dollar amount of those returns. So sales, less the discounts, less returns, give us our net sales. And hopefully you'll remember the rest of this income statement. So sales less cost of goods sold gives us our gross profit. Then we subtract operating expenses, and that gives us our operating income. And then we have the non-operating items. So revenues and expenses that aren't core revenue. So non-core revenue often can be like investment revenue. So interest revenue or dividend revenue, it depends. If we were a bank, interest revenue would be a core revenue. It would be up at the top. But for most companies, it's not the core revenue. Likewise, interest expense goes down here. But recall, if it's on the cash flow statement, interest expense is actually or cash paid for interest is actually an operating activity. But on the income statement, it gets listed as non-operating. So we have differences there in the categorization of interest. And then also gains and losses will go down here. So ordinary gains, ordinary losses. And usually that's from selling property, plant, and equipment. And then we arrive at income before taxes. I'll just say IBT, income before taxes, subtract our income tax expense, and we arrive at our net income. So that should just be a big overview of the income statement for a retailer. I do want to point out one thing. This income tax expense, we'll see later in the chapter that the way we cost our goods up here, the way we arrive at this expense for cost of goods sold, will affect income, operating income, income before taxes, and then will have an impact on income tax expense, which very much affects a lot of our business tax planning. Let's go over here and look at the basics, the real basics of the inventory account. Recall, the role of this account is to track cost and volume of the goods. So it really has two purposes. What's the quantity of the goods that we have available for sale, and what's the cost? So usually we have a beginning balance, so beginning inventory. We add in purchases. And the whole idea here is that costs go in, right? Costs go into the account. And then beginning inventory plus what we bought gives us the goods available for sale. That's everything we could sell. So what we started with plus what we added are all the goods available to be sold. And generally speaking then, either we sold them, so cost of goods sold, or we didn't, and they're still on hand in ending inventory. Now that's a real basic framework. We'll get more specific here in just a minute. So we have costs coming in with purchases, and when we sell the goods, the costs go out. So cost in, cost out. That's why, I like to think of the inventory account as a cost flow. Well, let's look a little more specific again. So that's the big picture. Now let's look at it a little more closely. So with more detail, what are we going to look at for this particular, I guess actually two chapters, chapters 8 and 9. So again, we have beginning inventory and purchases of the goods. And all of those costs go in. But here's the question, what costs? Well, we have the cost principle that's going to define that from back when we were looking at the conceptual framework in chapter 2, the cost principle. Well, basically it's going to say all costs to acquire these goods and get them ready. So all costs to acquire and get ready for sale. So all costs to acquire and get ready for sale are going to go in as purchases. So that's going to be our purchase price, if we have to pay shipping, if we pay insurance during transit, insurance cost, if we have to assemble the goods, all of those costs until the goods are ready for sale. But once they're ready for sale, then we stop capitalizing the cost in the inventory account and the costs start to become expenses. So once the goods are ready for sale, then when we're insuring those are going to be insurance expense. And once those are out on display, getting them, trying to sell them, those are going to be sales expenses. But again, until they're ready for sale, for the most part, the costs are going to be capitalized as inventory. Now, if we buy goods, we can also return goods. Oops, I'm going to go over here on my down arrow. So if we return some of these, we're going to take them out of the inventory account. So, they physically leave. We also might pay early, and sometimes if we pay early, we get a discount on our purchase price. So purchase discounts will cause costs to go down, right? If we bought it at $100, but we'll get a $2 discount, then the net purchase price is $98, so we want to reduce our cost by 2. Okay, so that's factoring in purchase returns and discounts. So now we take beginning inventory, net all this purchase stuff, and we have our goods available for sale. And if we sell the goods, then we will expense those as cost of goods sold. Now, it's also possible some of those goods we sold are going to be returned to us. If those come back, we put them back in. And those, instead of purchases, those are sales returns. And again, the focus is that sales returns, that cost is going to come back in. We don't put them back in at the price we sold them for, but at our cost. Okay, so then we have ending inventory. So if we have a perpetual inventory system, the accounting system is telling us, here's the ending inventory we should have on hand. Well, what will happen is that we will also physically count the inventory. So we'll stop everything, and we will count our goods, or we may even sample the goods, statistically sample the goods and project that sample to the population as a whole, but we'll arrive at our ending inventory cost based on a physical count. Now often these don't agree. Here's what ought to be there and here's what's not there. And that's often due to theft, breakage, that kind of thing. So here we have a dollar amount here. We need to write it down to the actual amount. So we have a loss. So we debit something like inventory loss and credit inventory to represent that. So again, that can be due to theft. It could be due to the goods have just been broken or damaged goods. And it could even be, that the goods are just obsolete and we can't sell them. They're just they're not good enough to be sold. So then we have ending inventory at cost. Again, this is at cost based on a physical count. One last thing we're going to do. Then we're going to take that same volume of goods and we're going to look to see, have the value in those goods gone down. If the value has gone down, we're going to write it down. If it hasn't gone down, then we leave that dollar amount at cost. Oops. So, get this back. So, we're going to report the final thing we'll do at the end of the accounting period is we will compare cost and market. We mean market value, which is really our replacement cost. We will compare this cost with replacement cost. If we had to buy those goods again, has it gone down? Usually it hasn't, because in periods of inflation, market's going to go up, 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 and up. But if it has gone down, we've had an economic loss. And if we have, we're going to record that loss. We'll see that in Chapter 9. But again, I just want to go ahead and lay it out, the big picture for inventory. And again, if there's been a gain, if there's been an economic gain here, we wouldn't recognize that economic gain, only the economic losses, because again, in accounting, we're conservative. We recognize economic losses, even if they haven't been realized in cash, but we won't recognize an economic gain until it actually happens. Okay, well, here's a problem. We're going to compare, there's two types of inventory systems, perpetual and periodic. A lot of companies keep a perpetual system, and just because accounting systems are sophisticated enough these days to be able to handle that, but some companies still do not. They keep what we call a periodic system. So let's go through and look at, well, what's the difference? Well, here we have a company that has beginning inventory of $80,000, and they buy purchases of goods for $20,000, and then they're going to sell them. The selling price is $50,000, but the cost is $35,000. If it's a perpetual system, this is the system you're probably most familiar with. When they buy the goods for $20,000, right, inventory goes up. Assuming they buy it on account, we've got accounts payable. Then, let's say that there were $5,000 of goods returned. That'll go out of inventory. That also reduces our accounts payable. Then when the goods are sold, right, we want to recognize cost of goods sold and the cost to go out of inventory, and also recognize this $35,000 of sales revenue. I want you to, I'm going to stop the video right now. I want you to go to the next page, and we're going to post those transactions into these accounts. Okay, if you posted those, your account should look something like this. You would have started with beginning inventory of $80,000. Your purchases increase inventory. Likewise, it increases accounts payable. Then your purchase return decreases accounts payable and decreases the inventory account. That's supposed to be P return there, by the way. After that, we could take the 80 plus 20 minus 5, draw our line, goods available for sale, $95,000. Then we had cost of goods sold. We debit that, reduce inventory for it. And then we end up with $50,000 of sales, and I didn't have the accounts receivable. One last step, 95 minus 35 gives us our ending inventory of $60,000. So we finally end up with that. Okay, so let's go back and kind of summarize, what did we know? Well, things that we knew beginning inventory in this case was $80,000. Right? This here, we knew that was $80,000. We knew purchases was $20,000. We knew purchase returns were $5,000. Okay, so that gave us goods available for sale. Just sneak ahead, right? 80 plus 20 minus 5, $95,000. So we knew goods available for sale, $95,000. And the goods available for sale, generally speaking, they're either sold or they're still on hand. And again, we're just not factoring in theft and that sort of thing. In this perpetual system, we knew cost of goods sold was $35,000. So what we really plugged or solved for at the bottom, 95 minus 35, we just solved for our ending balance and ending inventory. Let's peek ahead and look at that. So we knew 95 minus 35, we just solved for our ending balance in ending inventory. Okay, well, let's compare that with a periodic system. In a periodic system, purchases, so again, we're going to have our beginning inventory of $60,000. Beginning inventory of 80. We know ending is 60, right? Ending inventory is 60,000. So we know beginning inventory, again, is 80,000. So I'm going to put that in our account. Okay, so we know that. We also know they purchased 20,000. What will be different this time is that we're not going to record it in the inventory account. We'll have a separate purchases account. Likewise, when the goods are returned, we'll have a purchase return account. So we track those separately. They don't just get plugged to inventory. Okay? And so when the goods are sold, we don't track. Notice when the goods are sold, this entry here is made under the periodic. So we record the sale, but we do not record the cost of goods sold at the time of the sale because we're not tracking costs. We don't track the cost of the goods throughout the year perpetually. We wait until the end of the accounting period to do that. Okay, let's stop this video and post these transactions. Okay, so your account should look like this. We started with $80,000 in inventory. We put purchases in the purchase account and accounts payable. Purchase returns went into this purchase return account and accounts payable. And then we had sales, and again, we're not tracking accounts receivable. Okay, so, here's the question, what do we know here? Well, let me kind of go back. I kind of got a little ahead, of myself, I see. I want to skip back. Before we keep going on with periodic, let's go look at the income statement here. Back on the perpetual, we had sales of $50,000. So let's make a note of that. And we had cost of goods sold of $35,000 for a gross profit of $15,000. And then ending inventory was $60,000. Okay, so just want to document that. And I wanted to go ahead and do that because I want to show you it doesn't really matter whether we have a periodic or perpetual system. When we get to the very end of the reporting, when we report all of this, it's going to be the same numbers. What'll differ is here of the system. How we process it through the accounting system was what's going to be different. Okay, so we kind of have a lot of different stuff going here, but I want to point out we know a lot of the same things. So over here with the perpetual system, we know beginning inventory, right? We know that's 80. And we also know purchases of 20 and purchases returns of 5, just like we did before. So we still, even though it's in several different accounts, we still know goods available for sale is $95,000. Now over here, it's all in the inventory account. All of these numbers are in the inventory account. Over here, they're not. This is in the inventory account, that's in a purchase account, that's in a purchase return account. But we have the same concept of the goods available for sale. Generally speaking, again, for the most part, they're either sold or they're still on hand. Again, there can be theft and all of that, but that should be one of the smaller dollar amounts. So generally speaking, we either sell it or we don't. Under the under the periodic system, what will happen is we have to count ending inventory. So we have to count the physical goods. And so we do that, and we solve for that to be 60,000. And if we know that's 60, that's how we determine our cost of goods sold at the end of the accounting period. We know this is 95. If that's 60, then the cost of goods sold must have been 35,000. And we plug that at the end of the accounting period, and that's what's going to go on the income statement. Okay, so how do we get it there? Well, we have a lot of journal entries. So for the periodic system, it's going to look like this. We're also going to debit cost of goods sold, $80,000. And we're going to credit our inventory account. Again, that's for beginning inventory. So we're going to put beginning inventory into cost of goods sold. And then we're going to take purchases and put it into cost of goods sold as well. So we're going to move that $20,000 out of purchases and put it into cost of goods sold. So you got a debit to cost of goods sold and a credit to your purchases account. Okay. We also am going to close out purchase returns, that $5,000 that was in there. Remember, it's a credit balance account, so we're debiting it. And that's going to go to cost of goods sold. So we're going to move beginning inventory to cost of goods sold. We're going to move purchases to cost of goods sold. And we're going to move purchase returns to cost of goods sold. And then lastly, we're going to reestablish in the inventory account ending inventory. That's an EI if you can't read it, for $60,000. And we will credit cost of goods sold $60,000. So let me repeat. You're going to debit cost of goods sold, credit inventory for beginning inventory, $80,000. You'll debit cost of goods sold, credit purchases, $20,000. Debit purchase returns, credit cost of goods sold, $5,000. And then you're going to debit inventory for EI, ending inventory, $60,000, and credit cost of goods sold, $60,000. Let's go post that so you can see what's actually going to happen. I'm going to do this in blue. Okay, so the first transaction is that we actually are going to credit inventory $80,000. That was the first of those four. And we put that into cost of goods sold. So we debit cost of goods sold and credit inventory. And at that point then, right, we have a zero balance in inventory. The second transaction was to also move purchases. Excuse me, let me erase that real quick. We're also going to move our purchases. So I'm going to zero out the purchase account and put that $20,000 into cost of goods sold. So I have $80,000 and $20,000 in cost of goods sold. Third step is to zero out the purchase returns. So I debit purchase returns, credit cost of goods sold. And by now, purchase returns is zero and the purchase account. So the purchase returns is zeroed out and the purchases account is zero. All of those three, 0, 0, and 0. Okay, so let's look at, well, what do we have in cost of goods sold? Well, the $80,000 is beginning inventory. This should start to look familiar. That's beginning inventory. The $20,000 is purchases, and the $5,000 is purchase returns. Look familiar? It should, because that's similar to what we have over here in the inventory account. So that gives us goods available for sale, $95,000. Then the last step is we count the inventory. We know ending inventory was $60,000. So we debit inventory, when it's going to be transaction 4. So we debit inventory $60,000 and credit cost of goods sold $60,000. And that's our ending inventory. So we take goods available for sale, subtract what we didn't sell, and that gives us what we did sell, cost of goods sold. So here's what's interesting. If I look at my income statement for periodic, I still have $50,000 of sales. I have $35,000 of cost of goods sold, and we have $60,000 that will get reported on the balance sheet. So it doesn't matter whether I use perpetual or periodic, essentially I'll get the same results for the financial statements, but the way we process those, that's what will differ.